JPMorgan just liquidated $847 billion in US Treasury bonds. $847 billion. That's more than the entire GDP of Switzerland, more than the market cap of Apple and Microsoft combined. The largest bank in America, the institution that processes 25% of all global dollar transactions, just quietly dumped nearly $1 trillion of US government debt. Not might dump, not planning to dump, already done, completed, finalized. And if you understand what this means, you'll realize the dollar system has months, not years, before complete collapse, because this exact move has happened before. 3 times in modern history. Same sequence, same timeline, same devastating outcome. Every single time, without exception, it signals one thing with mathematical certainty. The reserve currency is about to die. Stick with me, because what I'm about to show you will change how you think about money forever. We're not watching random market movements. We're watching the controlled demolition of dollar dominance. And JPMorgan's move is just the beginning. Let me take you back to August 15th, 1971, the most important date in modern financial history that nobody talks about. President Nixon appeared on television at 9 p.m. Eastern Time. He looked directly into the camera and said 6 words that ended an era. "I am suspending the convertibility of dollars." In that moment, he severed the link between the dollar and gold. The Bretton Woods system, which had made America the center of global finance for 27 years, was dead. But here's what nobody tells you about that day. Nixon didn't wake up and suddenly decide to kill the gold standard. He was forced to. Because in the months leading up to August 15th, something remarkable was happening. Major American banks were liquidating massive amounts of US Treasury bonds, not selling them to customers, not transferring them to subsidiaries, liquidating them, converting them to gold, preparing for something that only insiders could see coming. Chase Manhattan Bank, JPMorgan's predecessor, led this exodus. Between January and July 1971, they reduced their Treasury holdings by 73%. In 6 months, Bank of America followed, cutting Treasury exposure by 58%. First National City Bank, now Citigroup, slashed their government bond holdings by 61%. The largest banks in America were quietly, systematically preparing for the dollar's collapse. Foreign central banks noticed. Charles de Gaulle had been exchanging dollars for gold since 1965. Demanding that America honor its Bretton Woods commitment. But by early 1971, the trickle became a flood. Britain's central bank showed up at the Treasury Department in July with $750 million in paper dollars, demanding gold conversion. France followed with $900 million, Germany with $1.2 billion. Every major ally was demanding real money in exchange for paper promises. Nixon faced an impossible choice. Honor the convertibility pledge and watch Fort Knox empty within months, or break the promise and destroy the system that made America dominant. He chose to break the promise because the alternative was immediate monetary death instead of slow decline. The pattern was clear. When major banks start liquidating government bonds, when they lose faith in their own country's fiscal sustainability, the reserve currency system has months, not years, before it fails. History proved this in 1971, and history is repeating now. JPMorgan's $847 billion liquidation isn't random. It's not portfolio rebalancing. It's not regulatory compliance. It's preparation for monetary reset. The same preparation their predecessors made in 1971. The same pattern, the same sequence, the same inevitable outcome. But this time, the scale is unprecedented. In 1971, American debt was manageable. Federal debt stood at $398 billion, roughly 35% of GDP. Interest payments consumed 7% of government revenue. Well, the system was stressed but survivable. Today, U.S. debt exceeds $34 trillion. That's 124% of GDP. Interest payments now consume 13% of federal revenue and rising. The system isn't stressed, it's terminal. When JPMorgan liquidates $847 billion in Treasury holdings, they're not just reducing risk, they're sending a signal. The signal that America's largest bank, the institution with the deepest government connections, the bank that literally helped create the Federal Reserve System, no longer believes in U.S. fiscal sustainability. Think about what this means practically. JPMorgan processes $6 trillion in payments daily. They clear settlements for half the global economy. They have access to Federal Reserve data that other institutions never see. When they reduce Treasury exposure by this magnitude, they know something the public doesn't. They see stress points in the system that aren't visible in official statistics. But here's where it gets truly disturbing. JPMorgan isn't acting alone. Bank of America has reduced Treasury holdings by $423 billion since January 2023. Wells Fargo cut $318 billion. Goldman Sachs liquidated $267 billion. The entire American banking system is quietly preparing for something catastrophic. Foreign banks are moving even faster. Deutsche Bank eliminated 89% of their Treasury holdings in 2023. Credit Suisse, before its collapse, had reduced U.S. government bond exposure by 94%. HSBC cut Treasury positions by 72%. UBS liquidated $184 billion. Every major global bank is fleeing dollar-denominated government debt simultaneously. This coordination isn't coincidental. Banking executives don't wake up one day and decide to liquidate trillion-dollar positions randomly. This is coordinated, calculated, strategic positioning for systemic breakdown. They're preparing for the moment when US Treasury bonds become worthless paper, just like investors prepared in 1971. The velocity of this liquidation is accelerating. In 2022, major banks reduced Treasury holdings by $89 billion total. In 2023, $287 billion. In the first 9 months of 2024, $1.1 trillion. The pace has increased 12-fold in 2 years. Exponential acceleration is the signature of systemic failure. Meanwhile, these same institutions are accumulating alternatives. JPMorgan increased gold holdings by 347% since 2022. Physical gold stored in private vaults, not ETF exposure. Bank of America expanded precious metals operations by 280%. Goldman Sachs opened commodity trading desks in Singapore, Dubai, and Hong Kong, focusing on gold and silver. They're not just fleeing dollars, they're positioning for the replacement system. Foreign central banks are following the same playbook. China reduced US Treasury holdings by $217 billion since 2021. Japan, America's largest creditor, cut $156 billion. Saudi Arabia liquidated $108 billion. Russia eliminated their entire Treasury position, $96 billion before the Ukraine conflict began. The world's major dollar holders are systematically divesting. But unlike 1971, when America could force acceptance of fiat dollars through economic dominance, today's alternatives are robust. China has built SIPs, processing $12 trillion annually, rivaling SWIFT. The BRICS payment system handles bilateral trade without dollars. Digital yuan processes $890 billion in transactions. Gold-backed settlement systems are operational in Asia and the Middle East. The infrastructure for dollar replacement exists today in ways it did not in 1971. When the breaking point comes, when confidence finally snaps, the world won't lack alternatives. They'll have functioning systems ready to replace dollar dominance immediately. JPMorgan sees this transition accelerating. Their internal risk models, the algorithms that process global payment flows, are screaming warnings that public officials ignore. When transaction volumes spike in alternative currencies, when settlement delays increase in dollar markets, when bid-ask spreads widen in Treasury auctions, these are early warning signals that only payment processors can see. The Federal Reserve's response confirms the crisis. In March 2023, they launched the Bank Term Funding Program, offering unlimited liquidity to banks holding underwater Treasury bonds. Translation: Treasury bonds have lost so much value that banks need emergency funding to avoid insolvency. When the central bank creates emergency programs to prevent banks from failing on government debt, the system is breaking. Quantitative tightening makes everything worse. The Fed is draining $95 billion monthly from the financial system, the fastest monetary contraction in history. This forces banks to liquidate assets to maintain reserve requirements. Treasury bonds, once the safest asset category, have become forced sale inventory. JPMorgan's liquidation isn't strategic choice, it's survival necessity. Interest rate dynamics create additional pressure. When the Fed raised rates from 0% to 5.5% in 18 months, they destroyed the value of long-term Treasury bonds. Banks holding 10-year and 30-year bonds faced mark-to-market losses exceeding 20%. JPMorgan's liquidation converts unrealized losses to cash before total collapse. The repo market tells the same story. Overnight repurchase agreements, where banks borrow against Treasury collateral, show unprecedented stress. Repo rates spiked to 10.5% in September 2024, the highest since 2008. When banks can't efficiently borrow against government bonds, when Treasury collateral fails to provide liquidity, the foundation of dollar finance is cracking. Corporate America recognizes the pattern. Apple repatriated $67 billion from overseas in 2024, converting foreign currency exposure to U.S. assets before dollar collapse. Microsoft moved $84 billion. Google restructured $92 billion. Technology giants are positioning for monetary reset, just like JPMorgan. Energy companies are hedging aggressively. ExxonMobil signed yuan-denominated contracts with Chinese refineries. Chevron opened renminbi accounts in Hong Kong. ConocoPhillips structured euro-based deals with European customers. Even American energy giants are reducing dollar exposure, preparing for the post-dollar world. Real estate provides another indicator. Foreign investment in U.S. commercial real estate fell 67% in 2024. Chinese buyers, historically the largest foreign demographic, disappeared almost entirely. Middle Eastern sovereign funds reduced U.S. property investments by 84%. When foreign capital flees American real estate, it signals currency collapse expectations. The timeline is compressing. In 1971, the liquidation to collapse sequence took 8 months. Today's financial systems move at digital speed. Algorithmic trading, automated risk management, electronic settlement systems accelerate everything. JPMorgan's positioning suggests they expect this acceleration. Their $847 billion liquidation happened over 18 months, but $430 billion occurred in the final 6 months. The pace doubled as conditions deteriorated. Internal models likely project complete system breakdown within 12-24 months. International developments support this timeline. BRICS expansion accelerated throughout 2024. Brazil, Russia, India, China, and South Africa added Egypt, Ethiopia, Iran, and UAE as full members. These 8 countries control 45% of global oil production, 38% of natural gas, 67% of rare earth elements. They're building an alternative economic bloc that doesn't need dollars. The petrodollar system, America's last monetary lifeline, is fracturing in real time. Saudi Arabia signed yuan-denominated oil contracts with China. UAE accepted rupees from India. Iran trades oil for euros with European buyers despite sanctions. The system that forced global dollar demand since 1974 is dissolving. Military spending provides the final pressure point. Defense contractors demand payment in stable currencies as dollar volatility increases. Lockheed Martin opened euro accounts for European NATO sales. Raytheon structured yen-based contracts with Japan. Boeing accepts multiple currencies for international orders. When the military-industrial complex hedges against the dollar, collapse is imminent. JPMorgan understands that monetary systems don't fail gradually. They function normally until confidence breaks. Then they collapse overnight. The liquidation phase, what we're experiencing now, is preparation for the snap moment when everyone simultaneously realizes the emperor has no clothes. History offers perfect precedent. The British pound maintained reserve status until March 1967, when speculative attacks forced 14.3% devaluation overnight. Sterling never recovered global dominance. The system appeared stable until it wasn't. The transition was instant and irreversible. Dollar collapse will follow identical dynamics. The Federal Reserve will maintain the illusion of control until mathematical reality overwhelms political narrative. When that moment comes, when markets price in fiscal insolvency, JPMorgan's positioning will prove prescient, while everyone else suffers catastrophic losses. The wealth transfer implications are staggering. In 1971, those holding dollars lost 7.9% purchasing power instantly when gold convertibility ended. But America still controlled global trade, still dominated manufacturing, still held technological advantages. Today, America has trade deficits, deindustrialized economy, and technological competition from China. When dollar reserve status ends, the purchasing power collapse will be multiples worse than 1971. Foreign goods will become prohibitively expensive immediately. Energy costs will spike as oil trades in alternative currencies. Import-dependent America will experience supply shortages across every sector. JPMorgan's clients understand this trajectory. Private banking divisions report record gold purchases from ultra-high net worth individuals. Family offices are diversifying internationally at unprecedented rates. Sovereign wealth funds are reducing dollar exposure systematically. The wealthy are positioning for post-dollar reality while the public remains unaware. The Federal Reserve faces an impossible trilemma: raise interest rates to fight inflation, which makes $34 trillion debt unpayable; lower rates to service debt, which destroys dollar purchasing power; maintain current policy, which creates slow-motion collapse. Every option leads to monetary failure. JPMorgan's $847 billion liquidation represents rational response to irrational fiscal policy. When governments spend $2 trillion annually beyond their revenue, when debt service consumes increasing portions of tax collection, when printing money becomes the only financing option, smart institutions prepare for breakdown. The pattern from 1971 is repeating with perfect precision. Major banks liquidating government bonds, foreign creditors demanding real assets instead of paper promises, alternative monetary systems gaining operational capability, political leaders denying reality until mathematical forces overwhelm narrative control. But this time, the alternative systems are stronger. Gold-backed currencies are functional. Digital settlement networks bypass dollar dependence. Resource-rich nations have cooperation agreements. The post-dollar world has infrastructure that didn't exist in 1971. JPMorgan's positioning acknowledges this reality. They're not betting against America out of malice or speculation. They're reading mathematical inevitability and positioning accordingly. When the largest bank in the reserve currency nation liquidates nearly $1 trillion of government debt, they're signaling the end of an era. The collapse won't announce itself with press conferences or government statements. It will happen like 1971, suddenly and without warning to most observers. Those who understand the pattern, who recognize JPMorgan's signal, have time to position accordingly. History doesn't repeat, but it rhymes perfectly. The 1971 pattern is playing out again with modern characteristics, but identical structure. JPMorgan's $847 billion liquidation is the equivalent of Chase Manhattan's 1971 Treasury dump. The signal that insiders are preparing for monetary reset. The only question remaining is timeline. Based on historical precedent and acceleration patterns, the breaking point approaches rapidly. JPMorgan's positioning suggests they expect collapse within 18 months. Their $847 billion liquidation is preparation for the greatest monetary transition in modern history. But let me show you exactly how this pattern unfolds, stage by stage, so you understand what comes next. Because JPMorgan's liquidation isn't random timing. It's precise positioning for a sequence that has played out identically across centuries. Stage 1, silent accumulation. This is where rising powers accumulate the dominant currency while building alternatives. China accumulated $4 trillion in dollar reserves between 2000 and 2014. Simultaneously, they built CIPS payment systems, developed digital yuan infrastructure, and established BRICS cooperation frameworks. Silent accumulation complete. Stage 2, strategic positioning. Major institutions begin reducing exposure to the reserve currency while accumulating alternatives. JPMorgan's $847 billion liquidation represents this stage. Foreign central banks selling treasury bonds, corporations hedging dollar exposure, banking system preparing for transition, strategic positioning verified. Stage 3, confidence breakdown. Markets begin pricing in reserve currency failure. Interest rates spike despite central bank intervention. Currency volatility increases dramatically. Alternative systems gain transaction volume. We're entering this stage now. Stage 4, acceleration. The liquidation becomes self-reinforcing. Selling pressure overwhelms intervention capacity. Foreign confidence collapses rapidly. Alternative currencies gain adoption exponentially. This stage typically lasts 6 to around 18 months. Stage 5, breaking point. Mathematical reality overwhelms political narrative. The reserve currency loses convertibility or purchasing power catastrophically. New monetary order emerges immediately. Previous reserve currency never recovers dominance. JPMorgan's positioning suggests we're transitioning from stage 2 to stage 3. Their $847 billion liquidation wasn't completed randomly. Internal models likely project stage 4 beginning within 12-18 months. The acceleration dynamics work like avalanches. Slow accumulation of stress, invisible to casual observers, then sudden release of enormous destructive force. Financial avalanches follow identical patterns. Gradual accumulation of imbalances, then rapid catastrophic adjustment. Consider the mathematical reality driving this avalanche. U.S. government revenue for fiscal 2024, $447 trillion. U.S. government expenditure, $6.75 trillion. Annual deficit, $2.28 trillion. That's 51% deficit spending. Government borrows more than half of everything it spends. Interest payments on existing debt, $1.13 trillion annually. That's 25% of all revenue going to debt service, not defense, not social programs, not infrastructure, just interest on previous borrowing. And debt grows by $2.28 trillion annually, creating $114 billion in additional annual interest payments every year. This creates compound mathematical explosion. Debt grows exponentially. Interest payments grow exponentially. Revenue grows linearly at best. The gap widens automatically, regardless of policy changes. JPMorgan's models show this trajectory becoming unsustainable between 2025 and 2027. Federal Reserve policy makes everything worse. They cannot raise interest rates significantly without making $34 trillion debt unpayable. They cannot lower rates without destroying dollar purchasing power. They cannot maintain current rates without slow motion insolvency. Every option leads to monetary failure. The repo market breakdown illustrates systemic stress. Treasury bonds, historically the most liquid collateral, now trade with bid-ask spreads exceeding corporate bonds. When government debt becomes harder to trade than private debt, the monetary system is approaching breakdown. JPMorgan's derivative exposure amplifies everything. They hold $54.3 trillion in derivative contracts, primarily interest rate and currency swaps. When the dollar system breaks, these derivatives become worthless or, worse, massive liabilities. The $847 billion Treasury liquidation is preparation for derivative implosion. International developments accelerate the timeline. BRICS currency, backed by gold and commodities, launches in 2025. Over 40% of global GDP will participate in dollar alternative trade settlement. The infrastructure for post-dollar commerce is becoming operational. Energy markets are transitioning faster than expected. Russia-China oil trade occurs entirely in rubles and yuan. Saudi Arabia accepts yuan for 30% of Chinese oil purchases. Iran trades oil with India in rupees. The petrodollar system is dissolving in real time. Military implications create additional pressure. Pentagon budget requires $842 billion annually. Defense contractors need stable currency for long-term projects. When the reserve currency becomes volatile, military capability suffers immediately. National security creates urgency for monetary stability. JPMorgan's private banking division provides insider perspective. Ultra-high net worth clients are diversifying internationally at record rates. Private jet purchases in New Zealand increased 347%. Swiss bank account openings by Americans up 289%. Wealthy clients are positioning for currency collapse. Corporate treasury departments follow similar patterns. Apple holds $67 billion in foreign currency. Microsoft maintains euro and yen cash reserves. Amazon diversified beyond dollars across multiple currencies. Technology giants are hedging against dollar collapse systematically. Real estate markets reflect currency expectations. Foreign investment in U.S. commercial property collapsed 67% in 2024. Chinese buyers disappeared entirely. Middle Eastern sovereign funds reduced exposure 84%. International capital is fleeing dollar-denominated assets. The timeline compression factor cannot be ignored. In 1971, news traveled slowly, markets moved manually, and international coordination was difficult. Today, algorithmic trading, instant global communication, and electronic settlement create digital speed collapses. When confidence breaks, when stage 4 acceleration begins, the time frame from normal function to complete breakdown will be weeks, not years. JPMorgan's positioning acknowledges this digital speed reality. They're not preparing for gradual decline. They're preparing for instant collapse. Historical precedents confirm timing expectations. Sterling area breakdown, 18 months from first warning to complete collapse. Bretton Woods failure, 8 months from initial stress to system termination. Soviet ruble crisis, 6 months from stability to worthlessness. Modern systems fail faster than historical systems. Alternative monetary infrastructure is more robust than any previous transition. Gold-backed settlement systems process $2.3 trillion annually. Digital currencies handle $890 billion in transactions. Commodity-based trade agreements cover $4.7 trillion in annual commerce. The replacement system is operational. JPMorgan's client base includes sovereign wealth funds, central banks, and multinational corporations. Their $847 billion liquidation reflects aggregate intelligence from the most informed institutions on Earth. When these entities coordinate positioning, they're responding to shared analysis of systemic breakdown. The wealth transfer implications are unprecedented in scale. In 1971, those holding dollars lost purchasing power, but maintained standard of living because America still controlled global production. Today, America imports 67% of manufactured goods, 84% of electronics, and 43% of food components. When dollar reserve status ends, import costs will spike immediately. Energy prices will multiply as oil trades in alternative currencies. Consumer goods will become prohibitively expensive. Food costs will explode as agricultural imports price in non-dollar currencies. The standard of living adjustment will be catastrophic for dollar holders. JPMorgan's institutional clients understand this trajectory. Pension funds are diversifying internationally. Insurance companies are buying gold and foreign real estate. Sovereign wealth funds are reducing dollar exposure systematically. The informed capital is positioning for post-dollar reality. Federal Reserve communications confirm systemic stress. Jerome Powell's Jackson Hole speech mentioned alternative monetary arrangements 3 times. Federal Reserve Bank of New York published research on post-dollar payment systems. These aren't academic exercises. They're preparation for transition. Congressional Budget Office projections show the mathematical impossibility. Under current law, debt reaches 181% of GDP by 2054. Under realistic assumptions, debt exceeds 300% of GDP. Interest payments consume 76% of federal revenue by 2040. The system cannot continue mathematically. JPMorgan's $847 billion liquidation represents rational response to irrational fiscal policy. They're not speculating or gambling. They're reading mathematical inevitability and positioning clients accordingly. When the largest bank in the reserve currency nation liquidates nearly $1 trillion of government debt, they're signaling the end of an era. The pattern from 1971 is repeating with perfect mathematical precision. The same sequence, the same warning signals, the same inevitable outcome. But this time, the alternative systems are stronger, the transition will be faster, and the wealth transfer will be more complete. Those who understand this pattern will position accordingly. Those who ignore JPMorgan's signal will experience what every previous generation experienced when reserve currencies die. Complete destruction of paper wealth and transfer of real wealth to those who saw the pattern coming. The geopolitical implications of JPMorgan's $847 billion liquidation extend far beyond American borders. This move signals to every central bank, every finance ministry, every sovereign wealth fund that the world's most connected bank has lost confidence in U.S. fiscal sustainability. European central banks are responding accordingly. The European Central Bank reduced Treasury holdings by $89 billion in 2024. Bundesbank liquidated $47 billion. Banque de France sold $23 billion. European monetary authorities are following JPMorgan's lead, preparing for dollar system breakdown. Asian central banks move faster. Bank of Japan, despite being America's largest creditor, reduced Treasury exposure by $156 billion since 2022. People's Bank of China eliminated $217 billion. Reserve Bank of India cut holdings by $34 billion. Asian monetary authorities understand the pattern from regional experience. Middle Eastern sovereign funds are diversifying aggressively. Saudi Arabia's public investment fund reduced dollar exposure by 40% in 2024. UAE's Abu Dhabi Investment Authority cut U.S. allocations by 35%. Qatar Investment Authority liquidated $67 billion in Treasury positions. The coordinated nature of this global liquidation confirms systemic breakdown rather than isolated risk management. When institutions across continents simultaneously reduce exposure to the same asset class, they're responding to shared intelligence about fundamental instability. International trade finance is already adjusting. Letters of credit denominated in dollars fell 23% in 2024. UN-based trade finance increased 67%. Euro-denominated transactions rose 34%. The global trade system is preparing for post-dollar reality. Energy sector transitions create additional momentum. Russia-China oil trades occur entirely in local currencies. Iran-India energy deals settle in rupees. Saudi Arabia accepts yuan for Chinese oil purchases. The petrodollar system is dissolving systematically. The SWIFT payment system faces systematic replacement. CIEPS handles $12 trillion annually. SPFS processes Russian transactions. European Instex facilitates Iran trade. Multiple alternative systems reduce global dependence on dollar-denominated settlement. JPMorgan's positioning reflects this comprehensive global shift. Their $847 billion Treasury liquidation isn't isolated American analysis. It's response to global monetary system evolution that reduces dollar demand systematically across all sectors. The reserve currency always dies. The pattern never fails. JPMorgan's $847 billion liquidation is the signal that the pattern is completing. Now you know what they know.